if I was a traditional money manager, I would want to tell clients that I can outtrade my competition and outtrade the markets. And the reality is that a lot of the best gains and a lot of the best investing is done with very little trading. If you've been watching the market, we had some of the worst down days since the early summer last week. And the market's come roaring back, allegedly, thanks to better than expected earnings numbers, especially within the tech sector. And now most of the losses that have taken place throughout the year have been erased. Many investors have had their best month of the year by doing really very little. We're going to talk a little bit more about ETFs and one of the games that money managers play. So over the last couple of weeks, when the U.S. markets had some really big sell-off days, what did a lot of money managers do? Did they tell their clients to buy more? To buy the dip? Did they call them and say, hey, we're going to put this extra cash that we have sitting in your margin account into these indexes? No, what they did is they sold. They sold positions at relative losses in order to look good to the hundreds of thousands of miseducated Americans who they prey on as clients. If you're your average American, you lack critical thinking skills. And so the fact that the market has price fluctuations and consolidation periods and fake dips and fake runs and short squeezes just is beyond you. Logic, not greed, would tell you that you should only have the exposure at any given moment that you're willing to have in the event of a major market sell-off. Meaning, you don't want to have more money in than you're willing to essentially lose, or lose a significant part of. It doesn't mean that it never comes back. The way the stock market works is through hills and valleys, and periods of our greatest sell-offs, our biggest market crashes, are followed by periods of the greatest market growth, the biggest gains. So if you're not invested at the bottom, you don't have the opportunity to really make significant market money. That's when people get rich who weren't rich before. And that's when the wealth gap increases. During periods of massive sell-off, during during stock market crashes, real estate market crashes as well, but during stock market crashes and the subsequent time right after them. Now, that doesn't mean that if the country goes into civil war or someone, lights a nuke off in Japan, that the game hasn't changed and now all of a sudden you don't want as high a percentage of your portfolio invested. And at that point, you might be taking money out. But on normal market sell-offs or even minor crashes or even big crashes, when all it is due is it's only due to some sort of technical issue with the fake business that makes the world go round, that's just a function of the market. And that's not something that you should bat an eye at, other than saying, man, it sucks that I've lost these gains. But you shouldn't take money out. But the person who lacks critical thinking and doesn't have a base or a basic understanding of how any sort of equity market works will say, oh no, the number's going down. I'm scared. It might never stop. We need to take money out. And even though math and history would tell a money manager to leave money in during a normal sell-off that gets attributed to treasury rates, That money manager at Fidelity or wherever is most likely, unless they have an agreed upon action, and this would only be for much higher tier customers, but an agreed upon action between the client and the manager about what happens during a sell-off. Otherwise, if they're just supposedly managing your money to the best of their ability, they're going to sell a portion of your portfolio to tell you that they were protecting you. But really all they did was guarantee your losses. This week, all the money that got lost last week has come back, and everyone's actually made a couple of bucks extra, except for all the people that sold off. I have good friends that I watched this happen to over the last 3 years. Multiple people, multiple times. And they missed out on the biggest runs in the market due to their money managers cashing out positions during temporary sell-offs and then only being able to capture back those losses with the reduced amount of shares in their portfolio, the reduced amount of exposure. And now they're just sitting with cash that's worth 75% of what it used to be. Half in some cases, depending on how bad the loss was. If you believe that the Fed is going to raise rates significantly in X amount of time, let's say by mid-2022, and you believe that that will correspond as it historically does with a major market sell-off, then sometime before that, you probably want to cash out some positions. And if you're doing that, most likely you want to cash out your most insecure positions first, followed by the ones that you have had the longest. So ideally, a perfect stock to cash out is one that carries a high degree of risk and you've had for a year or more, so that you're taxed on your capital gains at a lower rate, at the long-term gains rate, versus short-term gains. A good trader, when not trading derivatives or not day trading, will hold the majority of their positions for a year or more before trading them. A money manager will often take gains and capture those profits in some arbitrary amount of time, say like 6 weeks or 8 months, and then advertise to the client, look at these gains that I've captured. So let's say a stock goes up 30% in 2 months. They take the money out. Let's say then it comes down, but over time, over 13 months, the stock actually goes up 30% total. Let's say over 13 months, the stock actually goes up 25% total. So from the point that it was at 6 or 8 weeks, 10 or so months later, it's actually lost 5%. And the money manager to the dummy client will say, hey, look, I beat the market by 5%. But what they're leaving out is the tax rate on those gains, which most likely made it equal to 25%, because you had to pay a higher tax percentage on short-term capital gains than long-term capital gains. And then on top of that, they paid the money manager fee. And quite often with a company like that, there are also trading fees. So you pay, let's say 2% to have your money managed by the company, or maybe even 5 or 6% if you have a small account, because they don't really care about your business if you have a small account. And then they get paid a small amount, a transaction fee, for when they actually initiate a trade. So if they make no trade, they make less money. So let's say that there's a total of 10% out of those gains that gets extracted in fees and taxes. So the money manager who left the money in makes 25%. And the money manager who captured the supposed higher gains, the 30% versus the 25%, who supposedly made 5% more, actually their total gain, their total profit was, let's say, 17% or 18%. So they actually made 7% less than the less active trader. Now, if that person who had cashed out 2 months later has also put that money back into a different underlying, a different stock, they may well have lost money in that position or made a small amount of money. And if they went ahead and cashed out on that position as well, now they've incurred all of those fees again. So they've doubled the fees that the trader who just bought and held for 13 months incurred. So the person who's doing the short-term trading is telling the client, look, I beat the market by 3% this year. But really, year after year, they're losing to the market. They're losing to just a total stock market fund or NASDAQ. And on an individual level, they're making less money than the person who just bought and held the stock. Another piece of that, which comes in big when we start talking about ETFs, is a lot of stocks pay dividends. And so if you only hold a stock for a couple of months and they pay quarterly dividends, then you don't qualify for any dividends. So you don't get any money. Meanwhile, the person who held the stock for, let's say, 13 months may have collected 3 or 4 sets of dividends. They may have made 3%. Like you can reinvest. You can take the dividends as cash, or what I usually do is I reinvest them. So my broker automatically buys partial shares of the stock that's paying me the dividends. And over time, it adds up to whole shares. So I just keep getting shares for free. So not only do I make money on the shares that I bought in the first place, but now I have more, right? And I may have made 3% or 5% extra in just free shares, which would equal that 5% that someone may have outperformed me by holding something for the short term. Something a money manager does when they're not really trying to do their best for you is they will frequently trade the same money in and out. They increase the risk, right? So they may be doing this in a really savvy way if they're working for themselves, or we're talking some sort of, $100 million fund with some of the greatest minds in finance working it. They may keep buying little-known stocks or companies undergoing major changes, and they may have insider information, and they may trade in and out a lot, and they may continue to capture profits, and they may well beat the market. But normally what happens is somebody does the scenario I just explained about making 30% in 2 months versus 25% over 13 months, and then they just take that money, and instead of holding it and waiting for another good buy-in opportunity, they just jump into something else that they're hoping goes well. And when they do that with multiple stocks you own, you may find at the end of the year that while a bunch of your positions made good money, you're also down and you don't have that cash from the profits sitting there in your account to pay your taxes with. Overall, your portfolio is actually relatively down, and yet you're having to pay taxes on capital gains. And then what your manager will do in order to offset that is right before the end of the year, right around this time of year, they'll go ahead and close positions that, let's say, were at a loss in order to bring down your overall profits. But they're closing positions that, if they had just waited another year, would have turned into profitable plays and would have increased your equity. A perfect trading year is one where all of your underlying stocks, your whole portfolio, is stuff you want to have, and you don't make a single trade. And you just keep collecting dividends and putting off those long-term gains taxes. Of course, in reality, that's almost never going to happen if you're really playing the market smartly. And a lot of times, just your regular your regular guy or gal who doesn't have a money manager but also doesn't understand the stock market at all will just get like a Vanguard fund that's the total stock market. And they might just always add money to the total stock market. And they have no intention of trying to harvest losses or trying to beat the market. They are just going to ride the market for 25 years of their life. They never plan on switching jobs, or they don't have a high tolerance for risk. They have enough tolerance for risk to know that they need to be invested in the stock market. And they'll just keep adding money to the total stock market. So some years they'll make 11%, some years they'll lose 3%, some years on average, I think they'll make about 7% on their money. And even those guys can beat money managers just about half the time. Now, to me, on the scale of what you could do to capitalize on making gains within the stock market, just having the total stock market is probably not in my top 5. I think there are a lot of better things that you can do. If you are something other than lower class, so let's say you're middle class, and you invest just into the total stock market, you are in essence locking in your class level. Reason being is the average person in America at a certain level of income is going to have a retirement account. Your average person works for a corporation, and a corporation is most likely going to have someone or a company managing their retirement accounts, like their 401ks. And they're generally going to invest in the total stock market and bonds as well. Won't be actively managed, meaning there won't be specific stocks getting purchased. It will just invest in the stock market. And the stock market, historically, has grown. And historically, it's beaten inflation by a little bit, sometimes by a lot. But your average person in America looks at their wealth as the number in their bank account, not how they're doing relative to the rest of the people in their socioeconomic class. Whereas policymakers and the finance world looks at all of those people and their behaviors as a group. So if you're buying the total stock market, it would be similar to saying, okay, I'm going to buy the NFL. And I'm not picking certain players, or I'm not picking a certain team. I just want to buy the NFL. So if you just buy the NFL, what does that mean? That means that you believe that the NFL will continue to be around for a while, and you believe that the NFL will be prosperous. The NFL doesn't pay you a salary, so you only get paid if the NFL continues to prosper above the level at which it already did, right? So that means just because the NFL exists, well, that means that your stock doesn't go to zero, but it doesn't grow year over year. It just continues to exist. But if the NFL sells more merchandise and gets more viewership, et cetera, et cetera, et cetera, you have the ability to make some money. And with a good organization like the NFL, there's a probability that they may have some years where they go backwards, but in 10 years, they'll have probably figured out how to be a little more profitable than they are now. Now, the people that hope to actually increase their wealth, right? Because if you just want to guarantee that your money can remain middle class money, then you just put it in the total stock market when you're in the middle class. But if you want the opportunity to improve your quality of life, you have to take on more risk. And your average middle class American is very risk averse. One of the reasons they're very risk averse is that this country does not really provide the equal opportunity that it's advertised with, and it's much easier to maintain a class existence once you're there. It's not easy to go from lower class to upper class more than once, right? So if you're middle class and you grew up lower class and you know how much better that is, your thirst for more money and an upper class existence goes way down quite often. You're just glad to not have to worry about paying your power bill and having hot water, right? You're just glad you don't have to eat ramen anymore. You don't really care about getting lobster when you're out to eat. You're just happy to be out to eat. Now, using ETF or index funds would be like investing in a team. You like that team's management. You like their location. And you believe that that team, say a storied franchise like the New York Yankees or the New England Patriots, you believe that that team will outperform the league in, let's say, a 10-year period. And you can look at that by different metrics, right? Whether that be winning or player performance or player salary or the revenue of the team. For instance, the New York Yankees sells more merchandise internationally than the San Diego Padres. And so if your metric that you're looking at is Major League Baseball merchandise, then there'd be a good bet that owning just the New York Yankees over time would grow more, show more profits than owning a group of teams that averaged the output of the Padres. And if there's the New York Yankees on the best side of things and the Padres on the worst in terms of profits, and then you're averaging everything in between, then owning the New York Yankees would still be better than owning the whole league. And that's why I think it's generally better if you have a minimal amount of competence where you can find a fiduciary or an honest money manager to be an ETF or index funds as opposed to a total stock market fund. The last piece is like you're playing fantasy sports. So you're playing fantasy football and you're constructing the team all by yourself of the players from around the league that you think would make a dream team. There's a lot more risk in that. You don't know. Maybe the best player in the league, your superstar player, the player your team's built around, maybe they get injured in the first game and then they're out. And it's a major blow to the team. And they don't have a roster of all the players in the league. They only have a backup or two. And because they don't have that depth, they now have a big hole in the lineup. So this is the rub on the misinformation that the finance world will tell you. They tell you you can't beat the market. There is a very good chance that you can beat the market. As good a chance as winning your fantasy football league. It's a matter of having an extremely good understanding of how those players are going to perform, especially in respect to the year before, and then getting lucky on those players' performances. No injuries, no assault cases, no steroid violations. No, they come in, they're a perennial all-star. They put up great numbers, they improve as a player. You've got a winning formula. There are a lot of people who know baseball or who know football very well, and an above average amount of time They are at the top or near the top of their league. They're able to win year after year. And every now and then, they have a year where all of their best players get injured. And then they don't. But overall, they do better than the average player. The reality is, though, is no one is doing that year after year just as a fluke. And so you can't be somebody who doesn't take the sport seriously, who doesn't take the market seriously, has a superficial understanding of what's going on, and somehow invest your way by picking companies you saw on the news into making a fortune. In fact, that's usually the opposite of what you should be doing. Think about Tesla for an example. That's the mainstream example of a stock that blew up. But for the years leading up to its skyrocketing, and even during that long buy-up, you had news corporations trashing the company as an entity at all, saying what they made was crap and that they'd never amount to anything. And even as they set records, you still heard people saying that same thing. Since then, there hasn't been a Tesla come along. So a lot of people bought Tesla because they liked Tesla, who are on the winning side of that, but they're having a hard time replicating that performance this year, myself included, because you have to get lucky picking that golden pony. So in a lot of ways, if you're looking to understand market timing and beating the market, you can use the metaphor of how you play fantasy sports. If you want to beat the market making your own portfolio of individual stocks, you need to be prepared to become kind of obsessed, or you need to have a lot of money to pay a real hedge fund guru the big bucks. Otherwise, don't be fooled into thinking you're really going to beat the market with your entry-level $50,000 buy-in with T. Rowe Price. It's just not going to work that way. There's this term fiduciary. You can hire a fiduciary to give you unbiased financial advice that has to be independent of any sort of business tie. If you want somebody to really take a look at your assets and design a portfolio for you, and also maybe give you some advice on how to manage it. The sweet spot for many people is going a step further than just buying the total market, and as far as stocks go, investing in indexes and ETFs. Okay, one of the many reasons why ETFs are great is that they contain the companies that we all know and love, and usually over a 3 to 5 year period have better performance. When I started getting really into stocks and began designing my portfolio, what I would do is I would research the best performing ETFs and research the history of the different U.S. exchanges, the indexes, pardon me, and research the history of the U.S. indexes. And out of those best performing underlyings, I would research like the top 5 or 10 companies. If it was an industry I knew about, let's say semiconductors, then I already had companies that I liked, but in researching semiconductor funds, the most popular ones especially, made sure I wasn't missing something. In areas I didn't understand that well, let's say real estate trusts, researching the best REIT companies started giving me more of a base to understand that aspect of the equity market. And it was a good complement to my real estate license, which I'd only really done residential stuff with. When it came to what I knew, I was more liable to pick individual companies. However, like everyone else, there's much more that I didn't and don't know. And so much more of the money that I was allocating towards my stock portfolio would go towards indexes and ETFs. So for instance, what I didn't know about REITs resulted in me investing in just a ETF that had an actively managed portfolio of the best REITs that money can buy. There were other companies where I was eager to bet on just them, like say an Apple or a Tesla, and buying some of an underlying index or ETF helped essentially hedge against them underperforming. For instance, I didn't really want to buy an automotive ETF because I felt like Ford and GM and Chevrolet about 5 years ago were really going to underperform moving forwards. I didn't want that to retard the growth of Tesla. However, I didn't know a whole lot about different innovation companies in the landscape, and so by buying some ARK ETF, whose largest holding was Tesla, but they also had a lot of other good innovation companies, I was able to make my portfolio more well-rounded. What fund managers do is just the opposite in many ways. What they'll do in order to look like your portfolio is being more actively managed is they'll go to an ETF that's successful. So let's look at real estate equity trusts, REITs. So a popular one is VNQ, and that's Vanguard's real estate ETF. And another one is XLRE. So both of these are ETFs, and over the last 3 years, they've grown about 50% in value, so over 10% per year. And in their top 10 holdings are American Tower Corporation, Prologis Incorporated, Crown Castle International Corporation. Also, Digital Realty Trust is in there. But that was the top 5 anyway. CBRE rounds out the top 10. Now in VNQ, which is Vanguard's real estate fund, they've got in the top 10 American Tower Corp, Prologis, Crown Castle International Corporation, Digital Realty Trust. They're basically the same things. So what a fund manager will do is they will go in and they will purchase, for instance, American Tower Corp and Crown Castle and Prologis. And American Tower Corp has had some strong years. Over the last 5 years, if you had invested in just them, you have made 154% on your money. However, in this last year, interestingly enough, American Tower Corp would have paid you 10.5% on your money. And Vanguard in the last year would have paid you 30% on your money. The Vanguard real estate fund. that includes American Tower Corp. Well, what is American Tower? American Tower literally goes around and buys property that has cell phone towers on it. And they lease them out to different cell phone companies. That's what they do. Should be a good business. And people who know that business well and can follow along and are confident that American Tower is going nowhere may feel more comfortable just owning that stock and not owning the collection that is those two ETFs I talked about, VNQ and XLRE. However, if you were just buying into the market this year and you had bought those funds, you would have made more money than had you just bought American Tower Corp. And if something terrible happens to American Tower and their stocks go to less than 20% of either one of those funds is American Tower, so it'll be propped up by the other underlyings. Now that's a matter of risk, right? However, personally, I still don't know real estate trusts to the level of being what I would consider an expert, and so I'm more comfortable having someone actively manage those trades that doesn't make any money on how often they trade. So that's the beauty of these ETFs, is someone else is trading them. For instance, that Vanguard fund, there's a Vanguard money manager trading them, but because they're doing it as a separate account, you don't have to pay taxes, or you don't even know when those trades are going on. They're all managed elsewhere, and that guy is only getting paid for his performance, right? People will only come to the fund if the fund keeps outperforming the market year after year, or outperforming the competition year after year. So I trust him and I trust them to keep that top 10, right? Kind of like I might trust the Yankees to keep having a good team year after year. When it comes to REITs, I trust the management more than I trust myself putting together a team. Now, when it comes to PC makers, I trust myself more. When it comes to the parts and processors and all that, I feel like I know that industry pretty well, and I feel like when I look at an ETF for those PC companies or parts makers, that I wouldn't have some of those in my top 10. I wouldn't have some of those in my portfolio at all. So I prefer to have that. They're all relative hedges that you make within your portfolio, that you make within your life. Your portfolio doesn't need to be purely hedged with bonds. In fact, bonds are a bit of a waste. And if you think about it, a lot of money managers right now who are trading people's equity in and out, closing a lot of trades, are attempting to maybe mid time frame swing trade. They don't have access to crypto. And if you're trying to make swing trades, or you're trying to trade off a high volatility, crypto is the place to be doing that right now. But they don't have that. So that's another disadvantage, that someone who's just trading your money without you really paying attention, and them telling you that they're trying to beat the market by making multiple trades per quarter may be doing. Take a look at your portfolio that's rated, or that's being managed by one of the mainstream money management firms, and just type into whatever your bank is, or you can go to Morningstar, you can go to Yahoo Finance, just type in one of those companies and then look down and see in the section where it says ETFs holding this company, and see if a bunch of major ETFs don't already have that. You'll be amazed at where your money manager is actually doing a lot of his research. It's the same thing I've seen with a lot of independent gurus, and I can't knock their hustle, but they'll come out with their members-only newsletters that look at history from the end of time, and then talk about how they've done this incredible amount of deep diving across all of these different sectors. And then you look at the portfolio, and it's just the top 2 companies out of a mainstream ETF. It's not to say they're bad. It just means, just like in baseball, we all know who the good players are. And every now and then a scout catches somebody early. And every now and then a team gets a great draft pick. But for the most part, we all know who the big players are. And organizing your portfolio is more of math than it is being a guru or a future teller. And if you strategically organize your portfolio and then wait for the special companies that you're able to identify as special, because you either have a feeling or you have expertise in that area, and then you go in big on those, and that'll pretty much set you up for the highest probability of making money, making a maximum amount of money if you're just a regular person. And most of us are just regular people who aren't going to be able to spend enough time to master the market no matter what, and also don't want the stress that all that entails. Want to be happy and want to have a balanced life and want to accumulate some wealth for all the effort we're putting in, not just stay with the pack. Keep in mind, although there was a lot of good information in the last 40 minutes or so, this was all for entertainment purposes only, and this is not financial advice. If you'd like to support my podcast, check out my link tree on my Instagram profile or the links in the show notes. Buy one of my NFTs, help support dogs. There's also links to health and nutrition supplements that you can get discounts on and all of that stuff. Hope this helps.